Welcome to Plain Talk with Trillium Wealth. I'm Steve Laska, managing partner here at Trillium Wealth. And as usual, I'm with my partner, who is also our chief investment officer, Matt Gomoll. And how are you doing today, Matt?
Doing good. Yeah.
All right. So the topic at hand is I was watching the central bankers talk in Europe, Warsh and the other ones, about some new things going forward. And it was very, very compelling to me. And the big thing that, to me, my big takeaway was the end of forward guidance. So why don't you start with telling our folks what does forward guidance even mean?
Yeah. So forward guidance is the Federal Reserve or any central bank hinting at what they're going to do, right? Like this meeting, we held rates steady, but we see X number of rate cuts, or we see these conditions that are going to lead us to rate cuts or rate hikes. And interestingly, this has not been around forever. We didn't really have forward guidance in the past. Alan Greenspan once said, if you understood what I said, I probably misspoke. So there was a time not that long ago where the Fed intentionally didn't forecast what they were about to do, allowed them to be more nimble with responding to economic conditions at each meeting. Then we got to a period of where the Fed did get in a trend of giving forward guidance. And it's essentially like setting out a path and broadcasting to the investment market where we think things are going, not necessarily bound to them until we make a decision down the road, but it's that forecast that says, yeah, we see it going this way, and bonds just start pricing immediately, right? So instead of waiting till the event, or instead of bonds reading the economic conditions and reports that come out and pricing things as they see fit, the bond market got in the habit of saying, all right, what did the Fed say? All right, we're going to just take them at their word and forecast that that's going to occur.
So actually, I've talked about this in the past in our podcasts, where I talked about how the Fed traded in rumor a little bit. And it was interesting because I didn't necessarily know when it happened. I love your quote from Greenspan, but in doing some research and watching this, Kevin Warsh was around during the crisis in 2008 as a Fed Reserve governor. And he basically said, like, hey, we're unapologetic about the fact that we were given forward guidance back then. Like, we really did feel like we had to temper the market at times. We had to stoke the flames a little bit at times. And he said that it was a very useful tool during a financial crisis, but said, I don't think we need to do that right now. Like, we're not in a financial crisis, and we need to let the markets decide where the economy is going rather than us telling them. And it is, for people that don't know, there's an old adage, economists are just like weathermen. They're right 50% of the time. And so some of the time, people sitting on the Fed and looking at their teams of think tanks economists, it's like you also can't get any of them to agree. So whoever you have in there, if they're stressing something that's going in one direction, they may have been manipulating the market the wrong way. And to me, Warsh, like I said, he was unapologetic about it being done in the past, but he also seemed to say, we probably shouldn't have been doing this for a while now. Like, it's been the wrong move for a while.
Yeah. It certainly is a lever to pull, right? You can move rate, you can change rates, or you could just say words that hint that you might change rates. Either one is moving the market. And so back then, 08, 09, they took rates near zero. And so there was nothing else to pull on the lowering rate side. So then you could use guidance, right? So that's kind of where it makes sense. Like, it's a tool. It should be used when appropriate. And they used it back then. And basically Warsh is saying, yeah, it doesn't fit right now. We don't want it anymore.
What I thought, Matt, that was really cool, and I was really intrigued by. So what I was watching was on CNBC, watching a panel of the powerful central bankers in Europe and Warsh up there having a discussion. I loved the mutual respect that was shown. Yeah. And what really excited me for kind of the world economy is these are the most powerful voices in the world on interest rates and things that move markets. And they're in lockstep on this. Like, every single one of them said no more forward guidance. So it literally wasn't just the US saying it. And it was funny because every time the person running the panel tried to even get in there, they all laughed and were like, "No more forward guidance, right? No more forward guidance." I think one of them, maybe the guy, the great guy from Great Britain, like joked like, "Okay, I'm gonna give you a little bit here," and it was just kind of revisionist history. But the central banks working in concert with each other is a really good thing, and it's a thing where we've talked in recent podcasts about the power that the U.S. economy has and all those. We already have that power. I actually love that Kevin Warsh is not continuing the flex. I think it's better for us all if all of those people are saying we will conduct ourselves the same way. Now, that's not to say that they're going to raise rates at the same time. I absolutely talked about like we have different economies and different things that work for us at different times. So it wasn't like we're all going to raise rates at the same time. We're all going to cut rates at the same time. They're they're working on their economies, but all of them going forward with this because we know that it's a world market now, and everything that's happening has a trickle down effect. So, what does it mean, by the way, to our clients now? Like, what does it mean? What does it mean for their portfolios? What does it mean for what inflation looks like when when the big banks are no longer doing this?
Yeah, so I think it's important to note that Warsh from the start, taking over, has been very clear that price stability matters, right? So he's not saying, oh, inflation's fine, we're just going to let it run. He's saying, no, we have a mandate on price stability and we want to hit it. Now, I'm not going to tell you what we're going to do. I'm not going to forecast what we're going to do on rates to accomplish that. The Fed has many levers to pull, rates being one. But he's trying to anchor inflation expectations so that they don't stay elevated, right? That's what we want to avoid. And if rates, inflation rates stay elevated, you kind of get forced into raising the interest rate to try to tamp down on that inflation and that whole cycle. So he's trying to keep things anchored, wants to be in the hit that 2% mandate. And what this means without forward guidance, bond investors have to do more homework on their own, right? Instead of just waiting for the next Fed meeting and saying, oh, what did they say? We're just going to price, we're going to price in these rate cuts or these rate hikes based on what they said. And he said this specifically. He's like, no, you got to do your own research and evaluate all the different sources of data that we might be getting. And by the way, like the Fed might change some of their sources of data and how they collect it and, make it more timely. That can introduce volatility, right? There might be more volatility in the bond market because there's less certainty, less forward guidance, less certainty about what things look like 6 months, a year from now, because the Fed's not telling you anymore. Now the bond market's more responsive to things like jobs reports, economic condition reports, inflation reports, all those things. So that's kind of where I see it going. Doesn't necessarily mean it's a bad thing. It can be a healthy part of the economy. Just, I frankly think active bond managers matter a lot, right? So rather than just being tied to the aggregate bond index and just riding it out, I think having smart active bond managers really makes sense going forward.
Yeah, I've always been a proponent that managing bonds is often more difficult than managing equities. I mean, it's way more science based. And many years ago, I was the national sales manager at PIMCO, which is, you know, the goat of bonds, right? And had a lot of great managers, not just Bill Gross. Like the guys there were very talented. And so I think that the good news for our investors is I think it's great. I think it actually offers more upside opportunity for investors if their advisors have the skill sets that we do and do the due diligence that we do to go out and select the right managers. Like it going back to what our job is, and I enjoy this part, as I know you do as well, is going out and finding the highest quality managers. And, a lot of that, the whole world has kind of moved to this. They want to index everything, even in places where indexes aren't readily available. And bonds is one of those. So I'm actually excited for our investors that I think there'll be more opportunities in the bond market for them to do well. I've been in this business a long time, and the old 60-40 portfolio was a really good portfolio for retirees because if you hired a skilled bond manager, that was legit. Like you could build a really great financial plan around that, and people could live really well in retirement without taking on the risk and volatility of the stock market. So I think that's back. And I don't think that's going to change anytime soon. Like I said, I think they're pretty strident that this is the way forward. And if you just look at it, by the way, just look at the foreign guidance, like forward guidance. Like, it's ironic that we're going to do it and talk about it right now, because we have a live example this year. I mean, 2 months ago, 3 months ago, they were like, yep, or actually before the war, for sure, they were like, we're going to raise rates we're going to lower rates 2 or 3 times this year. And within a 3-month period, it went to, we might actually raise rates. So it was always nonsense. It was nonsense because the world is moving pretty fast, and the guidance was, like I said, it was like predicting the weather. Things are going to change.
Yeah, the Fed definitely, and all the central banks kind of took back their flexibility, because these chairmen and governors have mentioned, hey, it feels like when we give guidance, we're stuck on this path of expectations. And that's not good, because like you said, we could come into 2026, feel like, and give guidance towards some rate cuts down the road, and the bond market's going to price that in. And then we get a period like the Iran war kicking off, and through March, inflation's going up, oil prices going up. And a response could be, oh my gosh, the Fed needs to do something about this. But another response, allowing them to retain the flexibility, is say, well, wait, let's just wait. Let's let this play out, because we don't think 6 to 12 months from now, this problem persists to the point that we need to take action raising rates, right? Like, let it work through the system. Yeah, inflation's going to be higher for a while. It's going to extend past the war, but we don't need to take action. So allowing themselves that flexibility, not doing something, not raising rates, is a decision in itself, right? And so they have the flexibility to stop being stuck with the guidance and say, we're just watching the data. And the other thing, as Warsh came into this position, a lot of talk about independence, the Fed's credibility, some attacks on the Fed against Powell and Lisa Cook. It does seem like the Fed's independence, both with the Supreme Court ruling that you can't just fire a Fed governor out of nowhere, and then Warsh's actions, he's trying to make sure the credibility of the Fed is stable. Certainly, the administration would love some rate cuts, and he knows he can't deliver them right now, and so he's doing a pretty good job of trying to talk credibility, rebuild that for the Fed, while giving less guidance, being less predictable. He probably may not be able to deliver a rate cut that the administration wants right now, but the credibility side that he's enhancing is really good.
Yeah, you talked about volatility, and it's not just in the bond market; it'll happen in the stock market as well. And you and I are going to do a podcast here upcoming soon on the need for professional advice and advisors. And this is for somebody that loves this business like I do, and loves to help clients like I do. Like, volatility presents really great opportunities. So I don't look at it as a negative. Like, I don't look at why you use an advisor as you're protecting yourself from not doing well. I think that there's a side of me that looks and says, understanding markets and understanding networks provide more opportunity for you to do better, right? And volatility is a key in that. Like, over the last, it's been a while now, like 10 or 12 years, there hasn't really been a lot of directional volatility. So the truth is, there haven't been as many buying opportunities, and everybody's kind of sucked into this. I hope I get the next great IPO. I hope I'm going to make money if I buy NVIDIA at the right time. And the reality is, in normal markets where you have directional volatility and you can select good money managers and you understand how money and cash flow works, opportunities are abundant, because investors, what we see, right, are investors in general. It's not like you're at a certain age, Matt, you just had a birthday, you're 43, and somebody goes, like, here's $6 million, man. Here you go. This is it. You're not going to get any more ever again. This is $6 million. Start to manage it. Right. At that case, you'd probably be like, okay, I an index. Maybe that works, maybe it doesn't. We tend to accumulate money over time. And if I look at our own client base, um, our clients are really strong investors. Like they have X number of dollars when they come to us. And every year they're like, I have a little bit more money, or I have a lot more money because I did this transaction and that transaction. And if you understand directional volatility, you can take advantage of those things and people can do very, very well. Many more opportunities. I've seen stuff where, and a lot of stuff came over the last 12 years. When you retire, your retirement is based on a lot of luck on what the market did because you're moving this big chunk of money, right? And if you happen to do it at the wrong time, you might have a different experience than somebody else. These kind of things, I believe, bring a lot more efficacy to markets and investing when they go back to what they did in the old days, which is to say, capitalism works, market movements works, let the world decide what it is, as opposed to us telling you what's about to happen. And again, we can point to so many times where it was a false narrative and not intentional. I'm not accusing central bankers of doing anything intentional. They were dealing with the information they had in front of them at the time. And I can go back to 2008 and show you a lot of times they were right and show you a lot of times where they were just like, meh, we're wrong, including this last 4 months.
Yeah. Yeah. And I think it's important, there's going to be criticism over anytime you have something and you take it away, it's different. People react and say, oh, well, why are we leaving this system? And Warsh is not trying to make the Fed less transparent, just less predictive. Still going to have their meetings and still have output from the meetings and still explain why they view the economy, what data sources they're using, what they're seeing in the economy, and why they're making the decisions they're making. That's transparency. The added part of I'm going to tell you what we're going to do next that's additional. That's not necessary. And that is what he's saying we're going to get rid of.
Well, I think where Chairman Warsh, I love what you just said. And I think one of the things he pointed out as well is there's not going to be any of these press conferences like there have been for the last 20 years where the Fed chairman just randomly talks about what's coming up at the meeting and what might happen. Like he literally said, I'm going to talk less. Like he's very clear on it. You're not going to see a lot of press conferences. And that's what those press conferences were with Powell and people before. It was like, I'm going to get on here because I'm trying to temper the market or I'm trying to kick it in gear. He's literally saying, you will only hear from me when we have a meeting and when the meetings are. And unless there's an emergency, he's not suggesting there's not an emergency. Like something can happen where we call an emergency meeting, but it won't be like it has been for the last 20 years where it literally is the Fed chairman might talk at any given time and give you a hint. They're used to give hints of what might happen at the next meeting.
Yep.
And he's saying no more of that. And I think it's great. I really do.
Yeah.
I'm intrigued to see where it goes.
Those all need to be understood as deliberate communication strategies, right? Anytime a Fed governor's out there talking, they're not just off the cuff saying whatever they want. These are deliberate communication strategies to get a message out to the market. And it's a lever, right? Again, Fed can go talk and pull a lever, or the Fed can have a meeting, decide on rates, tell you why they did that, and that can be their lever, right? So this is just a different communication strategy.
Yeah, I would also say like we shouldn't be naive. Like it doesn't mean other people aren't going to be predictive. It doesn't mean other people like you're going to have economists from all the big wirehouses come out and tell you because I lived in that time, right? There's going to be plenty of people trying to tell you what's about to happen. I think the difference on some of the people that are going to tell you what's about to happen is they're actually making moves. Like the Fed has monetary policy and that's it, right? They're not investing dollars. So the cool thing is now you'll see some of the predictive nature of you'll follow the money. Like where is this money being invested right now? So I think you'll still get great data from really smart people, but it's smart people that they are legitimately moving the market through their actions and their movement of money. Like, there was a time where you would look and say, well, I know where the economy might be going because I'm watching the moves that Caterpillar's making. Like they're making these capital investments right now because construction's coming and they're doing all these things. And it's a better place to look, by the way. Like it's a big company with a lot of shareholders, and they're moving money in certain directions. Like I've spent a lot of time around a man named Sheridan Titman, who wrote the first paper on momentum, and he said there was a time when, and this goes back a ways, when I spent time with him. He's like, the greatest inside information that everybody has access to is when a CEO is buying their own stock back. And I said, what do you mean? And he said, like, not all CEOs, but really good CEOs. He's like, people think they're doing that to inflate stock price. He goes, the really great CEOs of the world, the Jack Welch's back in the day, if they're buying their stock back, it's because that they think their stock is a good investment. They're not just diluting it. They're not just doing some of those things. And what's the balance of what they're buying back and what they're reinvesting in the business? He's like, if they're buying all of it back, well, maybe they are making a move to inflate their stock as opposed to investing back in their own company. But he's like, there were very simple levers that you can look at on how the world really moves. And those are the things that really move it. That's not rumor. If a big company is investing their capital back into themselves, or they're buying stock back, or they're buying part of their stock back, these are all things that are like very quantitative on where those things will likely move. No, nothing's ever a guarantee.
Yep. And the markets having more of a say, they've already exercised their power, and we've seen the bond market exercise its power in the past when certain policy decisions are made and yields spike because investors get nervous and they don't like that policy, and maybe the administration moves off of it because they said, ooh, I see what went on there. Bond investors can demand more yield due to uncertainty. That's a feature that's going to present itself. If you know exactly what the Fed's going to do because they gave you forward guidance and they keep hitting their forward guidance like clockwork, there's less uncertainty and you demand less spread for that risk of uncertainty. If there's more uncertainty, bond investors are going to say, we're not sure. We have a view, we have an opinion based on all these things, but we need a little more compensation to invest in that. And that's okay, right? And bond managers will be able to take advantage of those things and express their opinion.
So, Matt, I think that just leads into next time. I think we really should, on our next podcast, advocate, just based on the information we gave. It's a really strong, compelling story for why should people use professional advice. And I think we're going to do that one next, right? Where we come out and say, there's always been a reason to do it, but this is kind of a catalyst on, again, having more opportunity by understanding what's happening in the markets and then tying it back to everything, be it your financial plan, your tax situation. So this one kind of led us into the next one, I believe, and we'll put that one out next. But we'll keep an eye out for the Fed and what they're doing. Any closing thoughts?
No, I think it's the Fed's in a good place. There was plenty of worry leading up to this transition about what things would look like. I mean, Chairman Powell was under investigation and Lisa Cook has a whole thing going on. So it was under attack. It feels more stable now. You're right. We're 2 months into this. It feels like things are going to be just fine.
Great. Well, thanks, Matt. And thanks to everybody for joining us again. As usual, we'd love to hear from you. If you have a topic that you want to hear about, obviously click and subscribe. And you should see us in more places coming up. We're trying to get our message out a little bit more. So there'll be many different places you can listen to us or watch us on our podcast. And again, we're here to serve you. So until next time, on behalf of Matt and myself, we'll see you in a week or two.